investors and more opportunity to expand their business to outside of the world. Now, how market characteristics vary among countries. Number one, stock market participation and trading activity are higher in countries where managers are encouraged to make decisions that serves shareholder interest. So where their corporate governance is high, in which, because the concept of the corporation is that those who own the company, they are different, those who run the company, they are different. So management run the company, but management is not the owner. Owners are shareholders who just hold the shares. So in that country, the stock market participation or market value capitalization is higher in that country, which encourages management to serve shareholder interest, not themselves. No, do not take bribery or in illegal activities, insider trading, and all those stuff. So when there is a greater transparency, the stock market participation is going to be high. So factors that include higher trading activity, number one, voting rights. If shareholders have more voting rights, then transparency will be higher. When transparency will be higher, trading activity will be higher as well. Legal protection of the shareholders. If something goes against the shareholders concerned, they can file lawsuit against the management. Government enforcement of the security laws. Anything, for example, the most security law is the publish your financial statements. So in some countries where these laws are relaxed, they publish their financial statement after 6 months of the last year. So in June 2022, they publish the financial report of company from 1st Jan to 31st December 2021. So the time lapse is 6 months. So it means security laws are relaxed over there. It means, so if somebody wants to invest in the company during this 6 months, he has no idea how much company is making profit, how much is their cash flows, how much how much are their total assets, total creditors, like that. So on that case, trading activity will be lower in that country. Corporate corruption is high in that country. Over there, trading activity will be lower. By the way, what do we mean by corporate corruptions? For example, the CEO of the company, he pledged or he make insider deals with the company to purchase raw materials, and that company belongs to his wife. So there is a quality compromise. Maybe the quality is not compromised, maybe the rate is compromised. The same quality stuff you can buy from other companies at cheaper rate, but since this is your wife company or your brother company or your friend company, so you ask raw material from your relatives or something to buy on increased rate. Maybe you are not compromising the quality, but you are not serving the shareholders interest, you are serving your family interest, your friends interest, right, your brother's interest, is like that. So level of financial disclosure. So financial disclosure, 4 statements are going to be disclosed publicly by every country, so by every company: income statement, retained earnings statement, balance sheet, and cash flow statement. If a country is encouraging companies to publish other requirements as well, for example, how much shares you hold of the competitive company, how much CEOs, how many investment CEOs has in other companies, you publish that record. So in that case, transparency is going to be higher and trading activity is going to be higher in that stock exchange of the country. Right? Any question? So here comes the end of the chapter. The summary is of chapter 3 that the foreign exchange markets allows currency to be exchanged in order to facilitate international trade. Commercial banks serve as financial intermediaries. So international money markets are composed of several large banks to accept and provide deposit. Which kind of deposit? Short-term deposit in various currencies. So this market is used primarily by governments and large corporations because they need short-term funds for emergency basis and huge funds. The international credit markets are composed of same commercial banks that serve international markets. So these banks convert some of the deposits received into loans, normally medium-term loans, so to the same governments and large corporations. The international bond market facilitates international transfer of long-term credit. Bonds are normally 5 to 20 years. So this is a long time period here. So normally they are for governments and large corporation. Of course, large corporation MNCs will go internationally, not the local business go internationally. If local business is going internationally, it means that local bank that local business is becoming huge, so that they are expanding. So the international bond market is facilitated by multinational syndicates of investment banks that help to place the bonds. International stock market enables firms to obtain equity financing in foreign countries. So why they go to other countries? Of course, to issue stock, to gather more financing, and reducing the WACC, weighted average cost of capital. So thus, these markets help MNCs finance their international expansion as well. Now, we are starting chapter 4. In chapter 4, exchange rate determination. So up till now, what we have discussed? We have discussed chapter 2, flow funds. We talked about over there, how funds flow from country to country. And then we talk about the financial markets. What kind of international financial markets we have? We have money market, international money market. We have international credit market. And then we talked about international bond market. And now we actually diving into the numerical world of international finance. How exchange rates are determined. So first theory, and then we go to the numerical side. So these are the learning objectives that we will be covering. So number 1, measurement of the exchange rate. So exchange rate movement, although we talked about on just on raw surface that when currency value is declined, we call this depreciation. When currency's value increase, we call this appreciation. We talked about over there spread, right? What is spread? Ask minus bid. And what is spread ratio? Ask minus bid divided by ask. So we call this spread ratio, right? So here, how we are going to measure depreciation and appreciation? Number 1. So comparing foreign currency spot rates over 2 period points in time. If the answer is positive, it means currency is appreciating. If answer is negative, currency is depreciating. So can anyone explain what is spot rate? Oliver. I cannot hear you. I cannot hear you. Sufyan, can you define spot rate? Tiffany?
Is it the point which the currency has to measure whether or not it's depreciated or appreciated?
Close to, but not right. Okay, EGA, RUGA. What is spot rate?
Can you hear me now?
Yeah, now I can hear you, Oliver. Can you repeat?
The spot rate is the rate, for example, what you get from the market in the current price.
Yes, if spot rate is the rate at that time in the market. So if you are conducting transaction right now, the right now rate is called spot rate at the spot. Okay, so how we measure the depreciation and appreciation? So these are the actual rates on which currency is going to be traded, not the future rate, but will be, not the expectation, will be. No, that are the actual rates that you are ready to have the transaction for the currency. We call this, these are spot rate. So spot rate, current spot rate minus previous day spot rate divided by previous day spot rate. So which is rate of change, new minus old divided by old, rate of change. We call this, if the answer is positive, this is appreciation or currency value has increased. And if the answer is negative, we call this, this is currency is D value, currency value is decreasing or depreciating. Call this appreciation and depreciation. So a positive percentage increase indicates appreciation, a negative percentage change called depreciation. So are we clear about the spot rate? Spot rate T minus 1 means previous day. So what happened between these 2 days? Today's rate minus previous rate. Not the future rate. Future will be, we don't know. Future is uncertain. Right? That's why we call this future rate. So these are spot rate right now, which is actual one right now, and yesterday's actual was. So you take a difference, take a percentage change. So this is called percentage change formula, new minus old divided by old. So today's rate minus yesterday rate divided by yesterday rate. So here we go, we have the example here. So we have dollar, value of Canadian dollar in dollars. So this is the value of 1 Canadian dollar right now, 0.7 up January 1st, February 1st it is 0.71, March 1st it is 0.703, April 0.697, right? So now you tell me, what is the appreciation and depreciation? So how this 1.43% is calculated? New value, February 1st spot rate minus January 1st spot rate divided by January 1st spot rate. If you calculate it, it is in percentage 1.43%, which is positive one. And we call this